So today I think a lot of the conversations that we're going to have with Sam is in that context. And what I really want to pick his brain and for you guys to share also is what exactly are the numbers actually telling you, right? From that professional point of view, in both perspectives, the sales side as well as the buy side. And maybe a couple of minutes to just introduce yourself and what you do.
Sure, no problem. Well, Sam here, I run a CFO advisory firm, so we have been around for the last close to 10 years, come April, about 10 years running this already. So started off more as a fractional CFO, but over time evolved to a CFO advisory shop. What that means is we serve both CFOs to modernize finance function or work with business owners or founders to build CFO function. But a lot of times when people come to us is to be here already, be it M&A, be it Series A, and that's why we knew each other in the tech ecosystem first. And over Omakase we talk about search funds, and end up Eric really went into the search fund space, and he now knows a lot more than me in that area. So yeah, so there's a bit of context in terms of what we do and what we have.
Okay, cool. So I think I would just jump into it.
Sure, go ahead.
Yeah. So I think we sit on both sides of the table, like helping sellers prepare books also for the exit, right? Helping buyers to for the financial due diligence point of view. So I think question is like for someone in this room who's only ever read like corporate annual reports, startup pitch decks, what makes a SME financial complete and different animal point of view? Yeah.
Okay, first and foremost, in Singapore context, in the very just Singapore context itself, most companies you'll be looking at will probably not be audited. So what that means is that a lot of them are being served one way or the other by the bookkeepers, or if not, their in-house finance team where they are more, I would say a lot of them are actually served by finance admin rather than even a finance manager or accountant. So that's something that you kind of look at it. I think Qing Jin over there will know, he used to be head of finance with Slick, so do let me speak to him on that, he will knows very well. But back to the whole point itself is, even though that is so, even when you go to other countries like Malaysia and a few other countries, their accounts might be audited, but it doesn't necessarily mean that the accounts are in proper shape. Because I always share with most people that audit and due diligence two separate schools altogether. And okay, I started my career in Myanmar, so that is even more interesting that effectively you have a lot of times where accounts are never really, for lack of a word, clean, never fully in the shape that will be in the form of what you see in a US listed company or even the shares listed company. So a lot of things have to be relied on certain techniques and certain areas to focus on really, is the revenue real? Is the earnings real? How do you decipher some of the liabilities that you have? So those are things that you really need to look into, and most of the times you wouldn't want that to be 100% FRS. I think it's really about being able to commercially understand what does that mean? What does revenue really mean? What does certain expenses mean? And for someone who have run the same kind of business before, you probably know that some cost seems to be a little bit different from what I have thought it would be. It might be still true, it might be still right in a certain way, yes, but at least those are the questions that has to go through some logical understanding to get to a certain conclusion that, maybe this one has a very different area that is actually in better shape. So so back to SME accounts, that is something that you see all the time. Most accounts are never in a good shape, but it still gives you snippets of things that allow you to understand the business well.
Okay, then if I can, the next couple of questions really on the sales side of things,
sure.
Right? And also building on what you just shared. So when an SME approach you, help me with my books, clean it up. What usually is the state of it?
Okay, let's put it this way. My team always like to come to me to say that, Sam, can you please stop giving us messy accounts? Because they always reply them and tell them that, to be blunt about it, if the account is not messy, they will come to us. And I think one of the key reasons is they didn't really understand what it means. I think a lot of founders are not, for lack of word, not exposed in the finance function or in the accounting function before. And because of that, they do not really know what it means to really keep the books well. Like, recently I had done with a tuition center. Actually, I was brought in by a lawyer. So they have a broker, they have, the lawyer came in, SBA stage at that point in time. And actually the acquirer I suspect it's a search fund, but I claim that it's a fund himself. So anyway, the deal didn't close. What happened was that, obviously for the founder himself for the longest time, he's just looking at it as if that it's just purely P&L. I know my revenue, I know my expenses, I know that I'm making money, my bank account seems to be going up. Very good business anyway. But last he found out was the balance sheet itself has so many hidden items. A lot of bookkeeping firm, and you will be shocked to realize that a lot of bookkeeping firm, because it's a fault of both sides. The founders don't provide the documentation and don't know what's the source of it, they can't account for it. So what the bookkeeping firm does, oh, whatever that is unaccounted for means you owe the company or the company owe you. So they park into this line called amount owed to a shareholder and so on and so forth. Next moment you sell that card accumulating to millions of dollars after many years. And then it becomes a debt line item over there, and frankly speaking, through that whole incident itself, what happened was, obviously the person who's looking at the buyer will say, this is debt line in nature. At the end of the day, because of debt line in nature, I see a risk there, I don't see what it is, I'm going to reduce your amount. But actually, to be blunt about it, there's a very simple solution about it. Because the amount owed to you, right? Actually, all you need to do is to ensure that you have liquidity out there. You just do, you pay back the company, then you put it back out before the whole transaction closes, then will be on. So I think there are things like this, there are nuances that, I think it's also being very, in the partnership area, I always believe that as a buyer and seller, especially in SME space, it's not about nitpicking everything. I think in the bigger transactions, we always go in a situation where we really go and nitpick every single thing, and after that, next moment, oh, your price goes down. But I can plan in the SME space when that happens, most of the time the SME owner will walk away. So the question is, how do you bridge the gap actually? And that's actually a more important thing to look at.
Yeah, no, absolutely. So I want to also preface my next question in that I think SME owners generally are very law-abiding, at least in this context of Singapore.
Yes, they are.
And they want to do the right thing. But sometimes there's a lot of blind spot, not because of intentions, but because of just don't know what to do, right? So in your opinion, coming again from the sales side, like what are those blind spots that you see? Like not intentional ones. Yeah.
Okay, so a few things over here, right? First and foremost, the most bad basic that you see, a lot of times you do realize that the corporate file is not in good shape. What happens is documentation, share transfers and all is not there. Next moment you knew it is that basically they were transferred the shares a few times, but the original founder is nowhere to be seen. They can't retrospectively go and fix the file anymore, and then you will have a problem. So that's one. Other things that you see also, revenue recognition. Sometimes what they do is they do cash accounting. So obviously money comes in means revenue, money goes out as expenses. Other typical kind of area that you see when you want. I think one of the other big thing that you realize is you'll be surprised that a lot of companies does not have unaudited financial statement. So there's a difference between management account and unaudited financial statement. So by the Companies Act, it did say that you need to have an unaudited financial statement, but it did say that you need to have a P&L, a balance sheet, a financial statement with the notes to it. So which means that actually, frankly speaking, that refers to the unaudited financial statement. But I think there are a lot of cases where they just treat their management accounts, P&L, balance sheet as just purely that. So I think those are some of the common things, at least on the finance side. Of course, from the legal side, I think that will share a lot more. You will see a lot of this, contracts not signed. You have a lot of friendship kind of deals being done. Frankly speaking, in Asia, it's a relationship rate, right? So you will always have that. So there will always be nuances of things, receipts not, parked in. Interestingly, the one that I had done about a year ago, they have 5 entities, different countries, all owned by the same shareholders. All the interco not done properly. Sorry,
can you say that again?
Okay, so he has 5 entities, all in different countries in Southeast Asia. And each of them, the interco, basically the intercompany transactions are not done properly. So give you an example of it was that it is meant to be an expense in Singapore and a revenue in Philippines. But what happened over there was, in Singapore it's treated as an expense, or should I say but in Philippines it's treated as an equity injection. And when we went to investigate, it was very during the due diligence, because we were brought in right before the due diligence, right? So when we were preparing for it, we were asking the question, why is that so? We went and asked the Philippines accountant that they had. He said, by law in Philippines, in this amount, it is an equity. It cannot be a revenue. Why is that so? And he can't answer me. So, you have things like this. And partially the reason for that is because, okay, I'll be blunt and annoyed. Sometimes SME owners want to optimize their tax. So expense here means less tax here, right? Equity there means no revenue, doesn't have that. I've seen another case quite recently, actually, I'm preparing. Revenue went. So all these things, back to the point, is technically are all these things legal? It's a grey area. But legality-wise, there are situations like this. And sometimes unknowingly, like the interco case unknowingly.
Yeah.
But other cases is they are still within the right framework of legality. It's just that they have so many structuring that goes on that end up it inflates into the revenue. Like for example, this case is the revenue was represented before we came in to help them by the previous broker was almost like 9 million housing. But when we went in, we realized that it's actually just all the structuring of everything from revenue, right? The revenue drops to 2.5 million because of all the intercodes inflated. By rightfully the EBITDA remains the same. But when you go in and do it, the intercodes are not. Actually, intercodes are very big thing. It's not being properly done up. End up your EBITDA up to be actually ironically is lower than what's expected. So those are things that you see. Is it intentional? No. A lot of times it's actually their own keepers that is doing these things. But frankly speaking, there's also the part where when you are acquiring a company, you need to kind of dissect through all these noises.
Very helpful. I'm going to switch sides.
Sure.
Closer to us.
Yes.
Right? Now, put the head of your buy side.
Sure.
Advisory. Right? So we spoke about normalizing your data.
Yeah.
And like to get your thoughts on what a common normalization is. That's one. And then number two, also now assume the seller's being a little bit naughty.
Mm-hmm.
Like they want to slip something by you, and what are those also the common things that you see?
Okay, so normalization, I think there are a few that was covered just now already. Very commonly, you have other incomes, you have from a revenue standpoint, also because cash accounting is being done, so some of the deferred revenue is not taken into consideration as well. So therefore, that kind of inflates a little bit on the revenue side. Of course, from the expense side of it, accruals not done also. They might delay certain invoices right before selling. So then all of a sudden all the process comes in thereafter. So other things that and I think in Singapore context, a very normal one is of course the uncovered price. That comes in. I have a bit of two minds to that because it could be a situation where actually by right some expenses they will not have spent enough for the government grants.
Yeah.
So therefore dissecting the intent, the government grants, but if you are on the buy side, I always share with most people is when you are buy side you have a buy side norm, when you are sell side you have a side side norm. Yeah. Everyone will say it's market norm, but actually frankly speaking there's two sides to the norm. Of course if I'm taking the head of the buyer side, the fact of the matter is that usually you want to normalize that out. So on the balance sheet itself, very commonly you also observe that they have a lot of liabilities that are non-interest bearing in nature. Because most deals are, I believe, every cover is done on a cash-free, debt-free basis.
Yeah.
But of course, the whole conversation of cash and debt, there's cash light, there's debt light. So, and a lot of it can be debt light in nature. Deferred revenue can be debt light in nature. Of course, if sellers want to be naughty, a lot of times is they take some off balance sheet in liabilities elsewhere, off balance sheet expenses. They pay just right before transaction, that few months itself, and they are planning to sell that year. All of a sudden, you will see, how come expenses went down so much? Because a lot of things they pay out their own pocket. Because wherever they pay out a company, there's 6 times, 4 times, or even 8 times, kind of changes. So I think those are things that you see quite a bit as well.
Okay. Actually, my next question is exactly that. Like the off-balance sheet stuff, right? That's very you cannot find one unless you know. So for the buyers, then how do you actually get a bit more knowledge on that? What are the common things that you see, like the off-balance sheet stuff?
I think the first question is there a bank reconciliation fully done? Naturally, if there's cash around, it's also to review through their bank reconciliation. You see actually where the cash and everything is going through for that onward. Cash is basically kind of like, of course, nothing is stopping them from paying out of their own pocket and all. So that is the other aspect of it. And I must say that it's not that easy unless you make a very strong commercial call or you understand that space well. So typically some things that you want to observe, one is historical trends, right? So when you look at trends and how it is, how does it look like? Is it that all of a sudden, not saying that it is definitely something they are trying to hide, but at least when there's a changes in the patterns of things, I always share with most people is go back to the first principle of the drivers of the company. When you talk about revenue, price times volume, right? What exactly is the price? As price increases, price drop, how does that changes? How's the volume looking like? Is that expenses that has historically over the last 2 years been spent on, but why have it changed? Not saying that it's wrong, but it could be that they did a transformation over last year and kind of increases it. But those are healthier signs. In terms of balance sheet itself, actually that's where legality comes in a bit more. And I think that covers that a bit more on that front. But effectively, I always share with most people when legal duty comes in, you have the whole long list of things. And on the whole long list of things itself, some of the things is all the declaration of all balance sheet items that is there. I think Eric spoke a little bit about rental. Actually, the easy solution of the rental part is you commit to me the rental at the same price. You can commit over the next 3 to 5 years, I'm okay with it. Right, so that's a simple solution around it. So I think those are some of the broad items. I think it's not about declaration. I would advise generally, maybe Ned might have a different view because from the legal perspective. I generally would advise going into the warranties and indemnities to kind of put indemnities on all these off balance sheet. It spoils the relationship sometimes because for lack of word, sometimes after the transaction is done, you must see it there. So you don't want to spoil that a little bit too much. And frankly speaking, like when you put indemnities there, you want to claim it, it's very troublesome, it distracts you from claiming. It's very common that I see sometimes some people who do ETA, I have a few of them, what they do is like, because I'm from the south side, sitting on the buy side, right, is they put a whole long list of indemnities there. And the excuse around that is, I have not done my due diligence, so I won't know this. I will flip it the other way around. Actually, it's better for you to do a due diligence on your end, rather than putting indemnities, because even if you put it there, you might not be able to claim back anything. It's just a lazy way out, or lack of what they're trying to save their resources for other things. My personal take is it leaves a lot of dispute and it distracts you from operation, and it's not worth it. Yeah, so those are things that I see.
Okay, cool. I think just still in the what's this the buy side stuff.
Yes.
So you've spoken about revenue quality.
Yes, it is.
Yeah. So buyers don't really buy revenue; they buy what revenue represents.
Yes, of course.
Right. So by the way, Sam is very active on LinkedIn. So do follow him and hello. I think he writes a lot of gems on M&A, which I personally consume myself. So what's your framework, right, for like stress testing whether the top line is like predictable, durable, transferable, and what specific questions should the client be asking the sellers?
I think it's not even asking, but rather what you should do to test the quality of revenue. So on the whole topic of quality of revenue, it depends on the sector and the area they are in. Let's take it as it's a B2B company with maybe say 30 to 40 contracts that is in. There will be an easy way for you to just test it in a way such that you ask for the contracts, matching it to the invoice, matching it to the contract. The invoices are paid. So that's what you look at from a quality of revenue standpoint. But of course, you are more like a retail, F&B, consumer space. You will always ask for access via system and do record back to the collections itself. Back to the point, cash cannot lie, but you need to also go back at looking at the revenue. So it's really about doing that reconciliation and test that the revenue are real. Of course, there are contractual stuff you want to look into on a contract standpoint. One very kind of obvious thing that I'm quite sure Eric and Ned will cover is that once you look at the contract itself, so in the B2B space, a lot of them might have a change of control clause. So that is something that you really need to pay special attention for, putting it in making sure that can transfer over to you before you can navigate the way to do the deal. Because the last you want is you get the deal next moment 20% in. So I think there are always three main things to how do you know it is that is whether first and foremost the revenue are really what it is, it can last, how repeatable these revenue are. And I think at the end of the day, you want to make sure that the revenue is really real. What it's saying isn't that, no nothing. is there artificial boost just because of anything? Of course, I'm a bit guilty of that sometimes on the sell side because I do, have situations whereby we do additional invoicing right before the deal is closed, or when we go out to the market, because obviously that kind of boosts up revenue a little bit more. Although they are real contracts, real area, but you want kind of time invoicing time because sometimes you just tell them, frankly speaking, revenue recognition is not all in practice, take it or leave it.
Okay. Last question for you before we open up the floor.
Sure.
Have you seen earnouts playing out?
Of course.
and what structure have worked best?
Okay,
on the
topic of earnouts, right?
Yeah.
I'm just going to put one context on the floor over here. Is that in Singapore context, in the strictest regulation of the tax, right? Actually, earnout is income taxable.
Then somebody that knows. Yeah.
A lot of people are not, sorry.
Yeah.
So I think that's one thing that I don't know how it myself until about 4-5 years ago. I must say that buyer's advisor is quite open about it. That's great because they want so the good thing is because they want the deal because it's a partnership eventually, right? So they want it to be smooth, they want one spot on that front. So the buyer advisor told us about it, and I was like, oh really? Because I have not thought about it myself. And then after that I realized, I checked back with some of my tax advisors and all, and true enough, anything that is tied to some form of performance or tied to some form of retention by strictest tax regulation, it is actually income taxable. So for whoever that's going to receive the money, the next moment they know it is that 20% less or whatever they're receiving. So that is where earnout comes in the picture. But of course, frankly speaking, as a sell side, sometimes we still accept it. What we do is we just get a tax advisor. We just write and look through the wording in the SPA, and after that, obviously what we do is that we ask him write a letter. And the letter, to be blunt about it, he will never say that this is not payable by tax. But what he will say is that on balance of things or whatever I'm seeing over here, is not taxing. It is capital in nature and not income in nature. So that kind of mitigates a bit, but it's not guaranteed that, I always tell my client, at the end of the day, take it as an honest mistake. Because I have done a deal. I asked an expert in it, my expert say I don't have to. But back to the earnout structure itself, I think if I'm taking the buyer cap, right, and I've done it many times before, obviously a few things you want to do. First, you want to make it binary, right? You want to make it binary. That means you hit or you don't hit. There's no such thing as a skill. But of course on the sell side, I will always negotiate for a skill. Meaning that if I meet, and my argument always is, if I miss by order today, look, it's not fair for me not to get anything at all. So therefore, that is a skill that you put in. So that's one. Second thing about earnout is, of course, what's the right target? I will say that revenue is always preferred in a certain sense, both from the buy side and sell side, because it is easier to look at. If you go into the EBITDA, and I must say that a lot of deals are going back to ETA. Why? Because ETA ultimately drives the real value of company, right? But the basis of preparation for it, there is a lot of arguments and figures about it unless you clearly define. So if you really want to go into ETA, we need to clearly define. Of course, on the buyer side and the seller side, they need to agree what's in and what's not. So we need to be very careful about what's in and what's not over there. Of course, this on the buy side, obviously you want more things inside. On the sell side, you want less things inside. So that is where you have to take on. Other things is, of course, from earnout standpoint, is retention. I think as a buyer, your intent for earnout a lot of times is more as an incentive to them. But of course, as a seller side, I see as part of my value and not an incentive. So of course, there's always this common approach of saying, even if the founders, kind of go sunning on the beach every day and not do anything, but still achieve the target, does it qualify for earnout or not? Because your seller will always say, you're buying the company based on this value. It's not based on this. But of course, if the earnout mechanism is used for the purpose of driving the value down the road, it's a bridge, say for example, whereby today I think the value is here, the seller think the value is here, because he knows that in the 1 year time that will be this amount, it's used as a bridge over there, then yeah, I think the whole reasonableness of putting the founders in, if the founders go off, that is fair. So I think those are nuances of things that we need to think about, we need to be careful about. other things, so one structure that I always share with most people, rather than going on an earn-out structure, that makes it win-win on both ends, is go on a partial sales structure. So if you sell 60-70%, the other 30% have a corporate option somewhere, whereby you have the rights to sell, they have the rights to buy, at the end of the day, based on the agreed mechanism, right, income of people. That usually works better because it's definitely capital gain nature. The other thing obviously is for earnout is I think the target is important. Sellers might put a very high projection just to attract the interest. Big best use of it if you're on the buy side. Or on the sell side, you want to make sure that you are reasonable on that.